You ever wonder what happens when a billionaire's son goes all in to prove himself? Here's the $108 billion answer. December 8, 2025. Paramount headquarters in Los Angeles. Based on the Reuters report that just dropped, David Ellison is about to do something absolutely insane. His company, Paramount Skydance, is launching a hostile bid for Warner Bros. Discovery worth $108.4 billion. Now here's the context you need to understand. Netflix had already won this deal on Friday, just 3 days ago. They secured a $72 billion agreement to buy Warner Bros. TV studios, film studios, HBO, and streaming assets. The deal was done, finished, announced to the world. But Ellison, he's not accepting defeat. According to the filing that went public this morning, he's offering $30 per share in cash, which is $18 billion more than Netflix's offer. The financing, and this is where it gets wild. Jared Kushner's investment firm, multiple Middle Eastern sovereign wealth funds, and his father Larry Ellison, the second richest person on earth, are all backing this play. The Warner Brothers board is scheduled to meet this afternoon to review the offer, but they've already told shareholders to take no action at this time. Every Hollywood executive is getting texts right now. Every agent is calling their clients. Because what happens over the next few weeks will determine who controls almost everything Americans watch on TV. And David Ellison, who's been trying to prove he's not just his father's son for his entire career, this is his moment. Win or go home. I'm Alex Morgan, this is Behind the Billion, and today we're breaking down the most aggressive hostile takeover attempt in modern Hollywood history. David Ellison's $108 billion bid for Warner Bros. Discovery that just dropped this morning. Now look, I've been following this story since the rumors started weeks ago, but what happened in the last 72 hours? This is unprecedented. I mean, we're talking about a deal that was supposedly finished, closed, done. Netflix had won. And then Paramount comes back with a hostile offer that's so large, so aggressive, that it's forcing everyone to reconsider everything. But here's what makes this story fascinating to me. This isn't just about money. This is about legacy, about proving yourself, about a son trying to step out of his father's shadow by making the biggest bet of his career. And whether this works or crashes spectacularly, we're watching someone risk everything on a single move. So let me take you through this whole story. Who David Ellison actually is, how we got to this moment, what's really happening behind the scenes, and why this matters for the future of Hollywood. Because I've spent the last 6 hours reading everything I can find about this situation, and honestly, the strategic implications here are wild. Let's start with who David Ellison is, because that context is critical. David Ellison was born in 1983. His father is Larry Ellison, founder of Oracle, worth around $130 billion depending on the day. And here's the thing about being the son of one of the richest people on earth. Everything you do gets viewed through that lens. Every success gets attributed to your father's money. Every failure gets magnified. According to multiple profiles I've read, including a deep dive from Bloomberg back in 2019, David grew up wanting to be a pilot. He actually dropped out of the University of Southern California to pursue aviation. But then in 2006, when he was 23 years old, he decided he wanted to make movies. Now, I can't verify every detail of this transition, but from what I've pieced together from various interviews, Larry Ellison basically gave his son a few $100 million to start a production company. That company became Skydance Media in 2010. And here's where David's story gets interesting. He could have just funded vanity projects, made artsy films, done the typical rich kid thing. But from what I can tell based on the movies they actually produced, he went the opposite direction. He wanted big commercial hits. Mission Impossible sequels, Top Gun Maverick, Star Trek films, Terminator movies. The strategy, and this is my read on it based on the pattern of their productions, was to prove he could succeed in the most competitive, most commercial part of Hollywood. Not indie films where you can hide behind artistic merit. Blockbusters where success is measured in box office numbers that everyone can see. And it worked. Top Gun Maverick, which Skydance produced and Paramount distributed in 2022, made over $1.4 billion worldwide. That's a massive hit by any standard. According to Variety's reporting at the time, the film saved Paramount's entire year financially. So by 2023, David Ellison has something to point to. He's not just his father's son anymore. He's a legitimate Hollywood player who's produced multiple billion-dollar films. But here's the thing, and this is crucial to understanding today's hostile bid. Producing movies is one thing. Owning a studio is something completely different. It's the difference between being a successful real estate developer and owning an entire city. So let's talk about how David Ellison ended up controlling Paramount in the first place, because that story sets up everything happening today. Paramount Pictures, originally founded in 1912, has been through approximately 1,000 different ownership structures over the decades. But the most recent chapter starts with Sumner Redstone, the media mogul who controlled both Viacom and CBS through his holding company, National Amusements. Now, Sumner Redstone's story is its own incredible saga, but for our purposes, what matters is that by the 2010s, Paramount was struggling. The studio was losing money, streaming was eating into their traditional business, and the company needed a major transformation. According to extensive reporting from The Hollywood Reporter and The New York Times, there was this massive fight within the Redstone family about what to do with Paramount. Sumner's daughter Shari Redstone eventually took control, and she started looking for partners who could revitalize the studio. David Ellison, whose Skydance had been producing hit movies for Paramount for over a decade, saw an opportunity. And this is where his father's resources become critical again. In 2023 and 2024, according to multiple reports, the Ellison family started negotiating to merge Skydance with Paramount. The deal that eventually closed, and I'm pulling this from the SEC filings and press releases, was complicated. Redbird Capital Partners, a private equity firm, partnered with the Ellison family. Together, they acquired National Amusements, which controlled Paramount, for around $2.4 billion. Then they merged Skydance into Paramount in a transaction that valued Skydance at around $8 billion. So by mid-2024, David Ellison becomes CEO of this combined entity called Paramount Skydance. He's now running a major Hollywood studio, not just producing movies, but controlling the entire operation. And here's my interpretation of what that meant to him. This was validation. This was proof that he could operate at the highest level of Hollywood, not just as a producer, but as a studio chief. He could point to this and say, "I'm not riding my father's coattails, I built something real." But there's a problem, and this problem is what leads directly to today's hostile bid. Paramount, even after the merger, is still struggling. According to their financial reports, the studio is burning cash on their streaming service Paramount Plus, which is competing with Netflix, Disney Plus, Amazon Prime, HBO Max, and about 15 other services. The cable TV business, which used to be a cash machine, is declining as people cut the cord. The movie business is hit or miss. The industry consensus, and I'm basing this on analyst reports and trade publication coverage from the last year, is that Paramount needs scale. It needs to get bigger to compete. A standalone Paramount just doesn't have the resources to fight Netflix and Disney long-term. So the rumors start circulating. Maybe Paramount merges with someone, maybe someone acquires them, maybe they acquire someone else. And then Warner Brothers Discovery enters the picture. Now let's talk about Warner Brothers for a second, because understanding what they own is critical to understanding why everyone wants to buy them. Warner Brothers Discovery was created in 2022 when AT&T spun off WarnerMedia and merged it with Discovery. The combined company owns Warner Brothers Studios, one of the most prestigious film studios in Hollywood with franchises like DC Comics, Harry Potter, and The Matrix. They own HBO, arguably the most respected premium cable network. They own CNN. They own a massive library of content. They own the HBO Max streaming service. According to the financial data, Warner Brothers Discovery has been struggling with debt. They've got around $40 billion in debt from various acquisitions and restructurings. Their stock price has been underperforming, and the CEO, David Zaslav, has been under pressure to either fix the company or sell it. So sometime in the last few months, and the exact timeline is still a bit murky based on what's been reported, Warner Brothers Discovery starts exploring strategic alternatives. They hire advisors. They start taking calls from potential buyers. And three companies emerge as serious bidders: Netflix, Paramount, and Comcast, which owns NBC Universal. Now, here's where the story gets really interesting. Each of these bidders has completely different motivations and completely different visions for what they'd do with Warner Brothers. Netflix, according to their public statements and analyst coverage, wants Warner Brothers' content library and production capabilities. They want HBO's prestige. They want the film studio's ability to make theatrical releases. Basically, they want to become a fully integrated entertainment company that can compete with Disney. Paramount, from what I can tell based on David Ellison's statements and the strategic logic, wants scale. They want to combine forces with Warner Brothers to create a traditional media company that's big enough to compete. They want to merge streaming services, combine film studios, consolidate distribution. Comcast, which eventually dropped out according to their president Mike Cavanaugh's statement today, didn't want to take on the debt and risk. So the bidding war starts, and based on the Reuters timeline and other reporting, this thing goes back and forth for weeks. Paramount submits offers, Netflix submits offers, they keep raising the price. Paramount reportedly submitted 6 different proposals over 12 weeks, according to the hostile bid filing released today. And then on Friday, December 5, 2025, Warner Brothers announces that Netflix has won with a $72 billion deal. The deal is structured as a mix of cash and Netflix stock, valuing Warner Brothers at $27.75 per share. Netflix would acquire the Warner Brothers film studio, the TV production studio HBO and HBO Max. They would not take the cable TV networks. According to the announcement, the boards of both companies approved the deal. It seemed done. But here's what apparently happened behind the scenes, and I'm piecing this together from the hostile bid filing and various news reports from today. David Ellison and the Paramount team believed the process was rigged against them. According to the letter Paramount sent to Warner Brothers' board, which was included in the hostile bid filing, they alleged that Warner Brothers management abandoned a fair bidding process and predetermined Netflix as the winner. The filing specifically mentions that Warner Brothers executives were calling the Netflix deal a slam dunk while speaking negatively about Paramount's offer to advisors and other parties. Now, I can't verify exactly what was said in private conversations, but the allegation is clear. Paramount believes they never got a fair shot, that Warner Brothers wanted Netflix to win from the beginning, and that they were never going to accept Paramount's offer no matter how good it was. And here's where it gets even more complex. There are political dimensions to this whole situation that are absolutely wild. According to Bloomberg News reporting, President Donald Trump met with Netflix co-CEO Ted Sarandos in mid-November. During that meeting, Trump allegedly told Sarandos that Warner Brothers should sell to the highest bidder. Now, what that conversation actually entailed, I don't know, but the fact that the President of the United States is weighing in on a Hollywood merger tells you how big this has become. And then there's the Jared Kushner angle. Kushner, who is Trump's son-in-law, runs an investment firm called Affinity Partners. And according to today's hostile bid filing, Affinity Partners is part of the financing consortium backing Paramount's offer. So you've got the president's son-in-law financially backing one bidder, while the president himself met with the other bidder. The political entanglement here is unprecedented for a Hollywood deal. In his CNBC interview this morning, David Ellison was asked about his relationship with Trump. He said he had great conversations with Trump but wouldn't characterize the discussions, which is a very careful non-answer that suggests there were definitely discussions, but he doesn't want to reveal what was said. So now we get to this morning, December 8, 2025, and the hostile bid. According to the filing, Paramount is offering $30 per share in cash for the entire Warner Brothers Discovery Company. Not just the assets Netflix wanted, but everything including the cable networks. The total value is $108.4 billion. The financing structure, based on what was disclosed, is fascinating. The Ellison family, which obviously has Larry Ellison's Oracle wealth behind it, along with Redbird Capital, has committed to backstop $40.7 billion in equity capital. That's real money committed right now. Additional financing is coming from Jared Kushner's Affinity Partners, the Saudi Sovereign Wealth Fund, the Qatari Sovereign Wealth Fund, and El Imad Holding Company, which is owned by the government of Abu Dhabi. So you've got American billionaire wealth plus Middle Eastern sovereign wealth all combining to finance this hostile takeover. The geopolitical implications alone are staggering. Now let's talk about why this offer is structured as hostile, because that term has specific meaning in corporate finance. A hostile takeover is when a buyer goes directly to shareholders with an offer, bypassing management's recommendation. It's called hostile because management doesn't want it to happen, but if shareholders think the offer is good enough, they can accept it over management's objections. In this case, the Warner Brothers Discovery Board met this afternoon and issued a statement saying they would review Paramount's offer, but are not changing their recommendation of the Netflix deal. They told shareholders to take no action at this time. That's corporate speak for "we don't want this Paramount deal, we want the Netflix deal, please don't accept Paramount's offer." But here's the strategic problem Warner Brothers board faces. Paramount's offer is objectively better in several ways. First, it's $30 per share versus Netflix's $27.75. That's an 8% premium right there. Second, it's all cash versus Netflix's cash and stock mix. Cash is more certain, you know exactly what you're getting. Stock can fluctuate. Third, and this is interesting, Paramount is arguing that their regulatory path is easier. They claim that combining two traditional media companies will face less antitrust scrutiny than Netflix, a streaming giant, buying a major studio. Now, whether that's actually true is debatable. Democratic senators have already warned that a Paramount-Warner Brothers combination would result in one company controlling almost everything Americans watch on TV. That's going to trigger serious antitrust review. But Paramount's argument is that at least they're not Netflix, which has drawn intense scrutiny from regulators who are worried about streaming consolidation and market dominance. Fourth, Paramount is offering to buy the entire company, including the cable networks, while Netflix only wanted select assets. For shareholders who want to cash out completely, Paramount's offer is cleaner. So David Ellison has constructed an offer that, on paper, is superior in multiple dimensions. Higher price, more cash, arguably easier regulatory path, cleaner structure. But here's the question, why is Warner Brothers board still recommending Netflix? Based on the reporting and analyst commentary I've read today, there are a few possible reasons. First, there are concerns about Paramount's financing. The Reuters article specifically mentions that Warner Brothers board has questions about whether Paramount can actually secure all the funding they're claiming. Having commitments is one thing. Actually closing a $108 billion transaction with money from multiple sovereign wealth funds is another thing entirely. Second, there are concerns about Paramount's ability to manage the combined company. David Ellison has been CEO of Paramount for less than a year. Can he really run a massive combined entertainment empire? Does he have the experience and credibility? Third, there are concerns about the strategic vision. Netflix has a clear plan for how they'd integrate Warner Brothers assets into their streaming platform. Paramount's plan seems to be combine everything and compete through scale. Is that actually a winning strategy in today's media landscape? And fourth, and this is speculation on my part, there might be personal relationships and trust at play. Maybe Warner Brothers CEO David Zaslav trusts Netflix's leadership more than he trusts David Ellison. Maybe there's history between these executives that we don't know about. But regardless of the board's concerns, Paramount has now put this offer directly in front of shareholders, and shareholders are going to do the math. If you own Warner Brothers stock and someone offers you $30 per share in cash versus $27.75 in cash and Netflix stock, which would you take? For most shareholders, especially institutional investors who just want maximum value, the answer is pretty clear. So now we're in this situation where the Warner Brothers board is recommending one deal, but shareholders might prefer another deal, and it's going to come down to votes and legal maneuvering and possibly court battles. Let me walk you through what happens next, based on how hostile takeovers typically play out and what analysts are saying about this specific situation. First, Warner Brothers board will formally review Paramount's offer. They're legally required to consider any serious acquisition proposal, even if they don't want to. They'll hire financial advisors and lawyers to evaluate whether Paramount's offer is legitimately superior to Netflix's offer. Second, both Paramount and Netflix are going to be lobbying shareholders directly. They'll be calling institutional investors, pension funds, mutual funds, anyone who owns significant Warner Brothers stock, trying to convince them their deal is better. Third, regulatory agencies are going to start examining both deals. The Federal Trade Commission and Department of Justice will look at antitrust implications. Given that Trump has already weighed in and Kushner is involved in Paramount's financing, there's going to be intense political scrutiny as well. Fourth, and this is where it gets messy, Netflix might try to improve their offer. If they really want to win, they could increase their price or add more cash to the deal. According to the original deal announcement, Netflix has a $5.8 billion breakup fee, meaning if Warner Brothers backs out, they owe Netflix almost $6 billion. That's a huge deterrent to switching to Paramount. Fifth, there could be legal battles. Paramount's hostile bid filing already alleges that Warner Brothers ran an unfair process. If this gets ugly, we could see lawsuits about fiduciary duty, about whether the board properly considered all options, about whether management had conflicts of interest. The whole thing could drag out for months. According to Ross Beniz, a senior analyst at eMarketer who was quoted in the Reuters article, the Warner Brothers Discovery acquisition is far from over. Paramount will appeal to shareholders, regulators, and politicians to try to stymie Netflix. The battle could become prolonged. Now let's zoom out and talk about what this means for Hollywood and for the future of entertainment. What we're watching here is the endgame of a trend that's been building for 20 years. The traditional media companies, the studios and networks that dominated the 20th century, are being forced to either adapt to streaming or die. Netflix proved that streaming could work at massive scale. Disney responded by launching Disney Plus and consolidating their content. Amazon bought MGM. Apple launched Apple TV Plus. Every tech company decided they needed to be in entertainment. And the mid-sized players, companies like Paramount and Warner Brothers, got caught in the middle. Too big to be niche, too small to compete with Netflix and Disney, too traditional to pivot as fast as tech companies, too much debt to invest aggressively. So consolidation was inevitable. The question was always who would merge with whom and who would end up controlling Hollywood's future. What makes this specific battle fascinating is that it represents two completely different visions for that future. Netflix's vision, based on their statements and strategy over the last few years, is that streaming is the future and everything else is dying. Movie theaters are nice but not essential. Cable TV is dead. The future is on-demand content that people watch at home on any device. So buy the best content creators like Warner Brothers and feed them into the Netflix machine. Paramount's vision, or at least David Ellison's vision based on his statements today, is that there's still value in traditional Hollywood, that movie theaters matter, that HBO's brand matters, that you need to be a diversified entertainment company, not just a streaming app. That scale across multiple platforms is how you survive. Who's right? Honestly, we won't know for years. Maybe Netflix is correct that streaming is everything and traditional media is obsolete. Maybe Paramount is correct that you need diversification and scale. Maybe they're both wrong and some totally different model emerges. But what we do know is that this decision, whoever wins Warner Brothers, will shape the entertainment industry for the next decade. If Netflix wins, they become a fully integrated content powerhouse with HBO's prestige, Warner Brothers franchises, and Netflix's global distribution. They'd have a real shot at dominating entertainment the way Disney dominated the 20th century. If Paramount wins, they create a traditional media giant that can actually compete with Disney and Netflix on scale. They'd have major studios, streaming services, cable networks, and a massive content library. Whether that's a winning strategy in the streaming era is the big question. Now let's talk about David Ellison specifically, because his personal psychology is central to understanding why this hostile bid is happening. From everything I've read about David Ellison, and I've gone through multiple profiles and interviews over the last few hours, there's this consistent theme. He's constantly trying to prove himself, to prove he's not just his father's son, to prove he can succeed on his own merits, to prove he belongs in Hollywood not because of his last name, but because of his talent and vision. And you can see that drive in every major decision he's made. Choosing blockbusters over art films because blockbusters have objective success metrics. Merging Skydance with Paramount to become a studio chief, and now launching a hostile bid for Warner Brothers despite already being told no. This is someone who doesn't accept rejection, who doesn't back down, who's willing to risk everything to prove a point. In his CNBC interview this morning, Ellison said there was an inherent bias against Paramount in the bidding process. He believes Warner Brothers never gave them a fair shot, and whether that's objectively true or not, he clearly believes it, and that belief is driving this aggressive response. There's also the question of his father's influence. Larry Ellison, who built Oracle into one of the most valuable software companies on earth, is famous for his competitive aggression. He doesn't lose, he doesn't back down, he fights until he wins. And you have to wonder how much of David's approach here is influenced by his father's philosophy. Is this David's decision alone, or is Larry pushing him to go all in? I don't know, I can't verify the internal family dynamics, but the Ellison family's willingness to backstop over $40 billion suggests Larry is fully supportive. Let's also talk about the financing for a minute, because the structure of Paramount's bid reveals a lot about modern global capital flows. The fact that Saudi Arabia's sovereign wealth fund, Qatar's sovereign wealth fund, and Abu Dhabi's government investment fund are all participating in financing this deal tells you something important about how entertainment is now viewed as a strategic asset globally. These Middle Eastern governments have been investing heavily in Western entertainment, sports, and media for years. Saudi Arabia's Public Investment Fund bought a major stake in Live Nation, the concert promoter. They invested in esports leagues. Qatar hosted the World Cup. Abu Dhabi owns Manchester City Football Club. The strategy, from what analysts have written about this trend, is partly about diversifying their economies away from oil, partly about soft power and global influence, and partly about genuine returns on investment. But it also means that major Hollywood deals now have geopolitical dimensions. If Saudi money is financing the acquisition of Warner Brothers, which owns CNN, does that create conflicts around editorial independence? If Qatari sovereign wealth is involved, does that affect how DC Comics movies portray Middle Eastern politics? I'm not saying those concerns are definitive reasons to reject the deal, but they're legitimate questions that regulators and the public should be asking. Now let's talk about the regulatory challenges both deals face, because antitrust scrutiny is going to be massive regardless of who wins. For Netflix's deal, the concern is market dominance in streaming. Netflix already has around 230 million subscribers globally according to their latest earnings. If they add HBO Max's subscribers and Warner Brothers' content library, they become even more dominant. Does that reduce competition? Does that give them too much power over pricing and content choices? The counter-argument, which Netflix CEO Ted Sarandos made according to his public statements, is that the entertainment market is incredibly competitive. You've got Disney, Amazon, Apple, YouTube, TikTok, video games all competing for people's attention. Just because Netflix gets bigger doesn't mean they have a monopoly. For Paramount's deal, the concern is consolidation in traditional media. A combined Paramount-Warner Brothers would control massive amounts of cable TV content, own multiple major studios, and have enormous influence over what gets distributed to movie theaters. Democratic senators have already said this would give one company control over almost everything Americans watch on TV. The counter-argument which Ellison is making is that the entertainment landscape has changed. Traditional media companies are struggling against tech giants. They need scale to survive. Blocking consolidation just helps Netflix and Amazon dominate even more. Both arguments have merit. This is genuinely a hard regulatory call. And then there's the political layer. Trump has already commented on this situation. Kushner is financially involved. Both deals will be reviewed by agencies run by Trump appointees. How much will politics influence the regulatory decision? I have no idea. I can't predict what Trump or his administration will do. But the fact that politics is even part of this conversation is unusual for a Hollywood deal. Let me shift and talk about what this means for the creative community, the people who actually make movies and TV shows, because that's been largely ignored in the financial coverage. Hollywood unions and guilds have already expressed concerns about both deals. According to statements from various guild representatives, consolidation typically leads to job cuts, less diverse content, and more risk-averse decision-making. If Netflix buys Warner Brothers, you've got one company with enormous power over production budgets and creative decisions. If you're a writer or director, you have fewer buyers for your projects. Less competition means less leverage in negotiations. If Paramount buys Warner Brothers, you've got a similar dynamic, just with a traditional media company instead of a streamer. Still consolidation, still fewer independent buyers, still concentration of power. The hope from the creative community, based on their statements, is that whoever wins will maintain multiple brands with distinct identities. That HBO will still be HBO, making prestige TV. That Warner Brothers will still be Warner Brothers, making big movies. That consolidation doesn't mean homogenization. But history suggests that's not what happens. When companies merge, they cut costs, eliminate redundancies, and centralize decision-making. That's how you justify paying $100 billion for an acquisition. You promise shareholders you'll create synergies and efficiencies, which is corporate speak for layoffs and budget cuts. So the creative community is right to be worried. This is going to change how Hollywood operates regardless of who wins. Now let's talk about movie theaters, because David Ellison specifically mentioned in his statement that Paramount would remain committed to releasing movies in theaters. That line was intentional and strategic. One of the concerns about Netflix buying Warner Brothers is what happens to theatrical releases. Netflix has historically preferred releasing movies straight to streaming, maybe giving them a limited theatrical run for awards eligibility. They don't care about box office numbers the way traditional studios do. Warner Brothers, on the other hand, is one of the biggest theatrical distributors in Hollywood. They release major event films like DC Comics movies, Harry Potter spin-offs, Dune sequels. These movies make hundreds of millions or billions of dollars in theaters globally. If Netflix owns Warner Brothers, do they keep doing big theatrical releases, or do they gradually shift everything to streaming to drive subscriber growth? Ellison is positioning Paramount as the pro-Hollywood choice, the company that will preserve theatrical exhibition and the traditional movie-going experience. Whether that's a winning argument depends on whether you think theaters have a future. My take, and this is just my opinion, is that theaters will survive, but in a reduced form. Big event movies, franchise films, experiences you can't replicate at home, those will still draw audiences. But mid-budget dramas, comedies, genre films, most of that is moving to streaming permanently. So both models might coexist. Netflix buys Warner Brothers and keeps making some theatrical films while prioritizing streaming. Or Paramount buys Warner Brothers and does more theatrical but still invests heavily in streaming. The difference might end up being smaller than the rhetoric suggests. Let's also talk about the breakup fee, because that $5.8 billion Netflix is owed if Warner Brothers backs out is a huge factor. Breakup fees exist to compensate the buyer if the seller changes their mind after signing a deal. They're meant to deter other bidders and ensure the seller is serious about completing the transaction. $5.8 billion is an enormous breakup fee. For context, that's almost as much as some companies are worth entirely. Warner Brothers would have to pay that to Netflix out of pocket if they accept Paramount's hostile offer instead. So even if shareholders prefer Paramount's $30 offer, they have to consider that $6 billion penalty. Does Paramount's extra value justify that cost? The math gets complicated quickly. Paramount could potentially agree to reimburse Warner Brothers for the breakup fee as part of their offer, but that hasn't been announced yet. If they do that, it makes their offer more attractive. If they don't, it's a major obstacle. Now let me bring in some historical context, because Hollywood has been through consolidation waves before, and we can learn from those. In the 1980s, Sony bought Columbia Pictures. Matsushita bought Universal, then sold it to Seagram, who sold it to Vivendi, who sold it to GE, who merged it with Comcast. Time Warner merged with AOL in the worst deal in corporate history, then unwound it. Disney bought Pixar, Marvel, Lucasfilm, and Fox. AT&T bought Time Warner, then spun it off and merged it with Discovery. The pattern across all these deals is that consolidation rarely works the way buyers expect. The promised synergies don't materialize, the cultures clash, the debt becomes overwhelming. 5 years later, everyone questions whether it was worth it. There are exceptions. Disney's acquisition of Pixar, Marvel, and Lucasfilm worked because they gave those brands autonomy while leveraging Disney's distribution and merchandising. But those were smaller, more strategic deals. Giant mega mergers like this Paramount-Warner Brothers proposal, history suggests skepticism is warranted. Getting two massive entertainment companies with different cultures, different systems, different priorities to actually work together is incredibly difficult. But maybe David Ellison has studied those past failures and has a plan to avoid them. Maybe he's learned from Disney's successes, or maybe he's about to repeat the same mistakes that have plagued Hollywood for decades. We won't know until we see the integration plan, assuming the deal happens. Let me also address the speculation about what other bidders might emerge. There were reports that Apple considered buying Warner Brothers or parts of it. Amazon is always mentioned as a potential acquirer given they already own MGM. Some analysts have speculated about private equity firms. But based on today's news, with Comcast explicitly saying they're out and no other bidders emerging in the hostile offer, it seems like this is now a two-horse race between Netflix and Paramount. Unless someone completely unexpected swoops in with an even bigger offer, which seems unlikely given the amounts we're already talking about, this comes down to Netflix versus Paramount. Now let's talk about what happens if Paramount actually wins this hostile bid, because the integration challenges would be massive. You'd have Paramount Pictures and Warner Brothers Studios, two of the oldest and most prestigious film studios in Hollywood, trying to combine. Both have their own executive teams, their own production slates, their own relationships with talent. Do you merge them into one studio? Do you keep them separate but under common ownership? How do you handle redundant positions? If both studios have a head of production, who gets to keep their job? Then you've got the streaming services. Paramount Plus and HBO Max would presumably merge into one service. What do you call it? How do you integrate the technology platforms? How do you handle subscribers who are on both services? Then you've got the cable networks. Paramount doesn't really have major cable networks, but Warner Brothers has TNT, TBS, CNN, and others. Those are declining assets but still generating cash flow. How do you manage that decline while investing in growth areas? Then you've got international operations. Warner Brothers has distribution deals and partnerships all over the world. So does Paramount. How do you consolidate those without disrupting existing relationships? The operational complexity of merging these two companies is staggering. It would take years and cost billions just to integrate the systems and structures. And during that integration period, you're vulnerable. Competitors can poach talent, projects can fall apart, subscriber growth can stall. You're so focused on internal reorganization that you lose sight of the market. This is why so many mega mergers fail. The integration overwhelms everything else. But David Ellison's bet is that the scale you gain from combining these assets is worth the integration pain, that a combined Paramount-Warner Brothers can compete with Netflix and Disney in ways that neither company could alone. Is he right? I genuinely don't know. The logic makes sense on paper, but execution is everything, and we've seen too many deals that made sense on paper fall apart in reality. Let's talk about timing, because the fact that this is happening in December 2025 is significant. The media industry is at an inflection point right now. Streaming growth is slowing. Netflix's subscriber additions have moderated. Disney Plus hit a plateau. The easy growth phase of streaming is over. At the same time, the traditional media business continues to decline. Cable subscriptions are falling. Box office has been inconsistent. Ad revenue is shifting to digital platforms. So these companies need to make big strategic moves now before they become irrelevant. Waiting another 5 years might be too late. The window for consolidation might be closing. That sense of urgency is probably driving both Netflix and Paramount to be this aggressive. They both know that whoever controls Warner Brothers' assets will have a major advantage going forward, and whoever loses might struggle to remain competitive. It's also worth noting that capital is relatively expensive right now compared to a few years ago when interest rates were near zero. Financing a $100 billion deal is harder than it was in 2020 or 2021. The fact that Paramount assembled this financing coalition suggests they pulled together every available source of capital to make this work. Now let's talk about what the next few weeks probably look like based on typical merger timelines and what analysts are saying. This week, Warner Brothers board will meet, review materials, potentially hire additional advisors. They'll want to understand exactly how certain Paramount's financing is. They'll model out the regulatory timelines for both deals. They'll wargame different scenarios. Next week or the week after, we'll probably see public statements from major shareholders. Institutional investors like Vanguard, BlackRock, State Street, and others will weigh in on which deal they prefer. Their votes will be critical. Before the end of the month, Netflix will probably respond. They might improve their offer. They might argue that Paramount's financing is uncertain. They might emphasize their regulatory confidence. They're not just going to sit back and let Paramount steal this deal. In January, assuming both offers are still live, you'll see lobbying intensify. Both sides will be meeting with regulators, politicians, opinion leaders, anyone who might influence the outcome. By February or March, we might have clarity on which way the Warner Brothers board is leaning and what shareholders actually prefer. And then it goes to a vote, probably in the spring, where shareholders formally decide which offer to accept. That's the likely timeline if things move relatively quickly. But as analyst Ross Bennis said, this could become prolonged. There could be legal challenges that extend everything by months or years. One more thing worth discussing is what this means for David Zaslav, the CEO of Warner Brothers Discovery. Zaslav has been under pressure since the Warner Discovery merger in 2022. The stock has underperformed. The debt burden has been heavy. He's made controversial decisions like removing content from HBO Max for tax write-offs, which alienated creators. If the Netflix deal goes through, Zaslav presumably exits with a large payout but loses his job. If the Paramount deal goes through, same outcome. Either way, his tenure running this company is probably ending. From reporting I've seen, Zaslav is close to Netflix's leadership and reportedly prefers their vision for Warner Brothers over Paramount's. But ultimately, if shareholders want Paramount's offer and the numbers work, his personal preference might not matter. Let me now shift to talking about what this means for consumers, for people who just want to watch good movies and TV shows. In the short term, probably not much changes. Both deals would take many months to close and integrate. You'd still have access to HBO, Warner Brothers movies, DC Comics content, all of it. In the medium term, you might see service consolidation. If Netflix buys Warner Brothers, HBO Max probably gets merged into Netflix. If Paramount buys Warner Brothers, you might see Paramount Plus and HBO Max combine. Either way, there would be fewer services to subscribe to, which some people would appreciate. In the long term, the question is whether consolidation leads to better content or just higher prices and less variety. The optimistic view is that bigger companies can invest more in high-quality content. Netflix with Warner Brothers could make bigger, better shows and movies. Paramount with Warner Brothers could preserve theatrical films and creative risk-taking. The pessimistic view is that consolidation reduces competition, which reduces incentives to innovate and keep prices low. Fewer independent studios means less diverse content. More power concentrated in fewer hands means creators have less leverage. Honestly, both outcomes are possible. The entertainment industry could consolidate into a few dominant players who make great content and serve consumers well. Or it could consolidate into a few dominant players who maximize profits at the expense of creativity and value. Which outcome we get depends on regulation, market dynamics, and the specific decisions made by whoever wins this bid. Now I want to come back to David Ellison personally and think about what success or failure here means for his legacy. If he wins this bid and successfully integrates Paramount and Warner Brothers into a thriving media company, he proves himself as one of the great entertainment executives of his generation. He steps completely out of his father's shadow. He becomes David Ellison, the man who built a Hollywood empire, not David Ellison, Larry's son who got money to play in Hollywood. If he wins this bid but the integration fails and the combined company struggles, he becomes a cautionary tale about overreach and hubris. He'd be remembered as the guy who destroyed two great studios through a reckless merger. If he loses this bid, it's less clear what that means. Does it prove the critics right that he never should have tried, that he's not ready for this level of deal-making? Or does it just mean he got outplayed by Netflix, a bigger and more powerful competitor? My sense, and this is purely my interpretation, is that David Ellison sees this as his defining moment. Win or lose, this is what he'll be remembered for. This is his shot to prove everything he's been working toward for the last 15 years. And the fact that he's willing to launch a hostile bid after already being rejected tells you how badly he wants this. He's not accepting no for an answer. He's going all in. Whether that's admirable determination or dangerous overconfidence, we won't know until we see how it plays out. Let me wrap up by connecting this back to broader patterns we see in business and entrepreneurship, because that's what this show is really about. One pattern that keeps appearing in these stories is that the biggest wins often come from the most aggressive, controversial bets. Bezos betting Amazon's entire future on AWS. Musk going all in on electric cars and rockets. Zuckerberg buying Instagram and WhatsApp for what seemed like crazy prices at the time. David Ellison launching a hostile $108 billion bid after being told no fits that same pattern. It's an extreme bet with massive downside if it fails, but potentially transformative upside if it works. Another pattern is that legacy and proving yourself matter more than just money. David Ellison could have just collected dividends from his father's Oracle wealth and lived comfortably forever. Instead, he's risking billions in his reputation to prove he can build something himself. That drive to establish your own identity, separate from your family or your past, shows up again and again in successful founders and executives. A third pattern is that consolidation happens in waves during periods of industry transformation. We saw it in oil, railroads, banking, telecom, and now entertainment. When an industry goes through massive disruption, the weak players get acquired and the survivors grow through combination. We're watching that play out in real time with this Warner Brothers situation. And a fourth pattern is that regulatory approval often determines winners in major deals. It's not just about who has the most money or the best strategy. It's about who can convince regulators and politicians that their deal serves the public interest. Both Netflix and Paramount are going to have to make that case convincingly. So that's where we are. December 8th, 2025. A $108 billion hostile bid that could reshape Hollywood. A billionaire's son trying to prove himself on the biggest stage. A battle between streaming's future and traditional media's last stand. Political intrigue involving the president's son-in-law and Middle Eastern sovereign wealth. And the fate of some of the most iconic entertainment brands in history hanging in the balance. I don't know how this ends. Maybe Netflix wins and becomes a fully integrated content giant. Maybe Paramount wins and creates a traditional media powerhouse. Maybe some third option emerges that nobody's predicting. But what I do know is that we're watching business strategy at the highest level. We're watching someone risk everything on a single massive bet. We're watching an industry transform in real time. And whether David Ellison succeeds or fails, whether this was genius or madness, it's going to be studied in business schools for decades as an example of high-stakes deal-making in the modern era. Alright, so that's the story. That's how a $108 billion hostile takeover attempt dropped on a Monday morning and threw Hollywood into chaos. That's how David Ellison is trying to prove he's not just his father's son by making the biggest, boldest, most aggressive bet of his career. Now look, this story is developing in real time. By tomorrow, new details will emerge. By next week, the situation might look completely different. I'm giving you my analysis based on everything available as of today, but this is fluid and fast-moving. If you want to understand how the world's biggest companies are actually built, how these massive strategic decisions get made, how business really works at this level, hit that subscribe button. I release new episodes every single day, deep dives into the strategies, the decisions, the moments that created billion-dollar empires. I'm Alex Morgan. Thanks for listening to Behind the Billion.